Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 top-ranked tech stocks to consider buying before their earnings releases for long-term upside. And the 3 of those stocks we're looking at today are Uber, AppLovin, and Pure Storage. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into our services, portfolios, and more. All right, so before we jump into these 3 top-ranked Zacks tech stocks to consider buying before their earnings releases, we're going to go over the broader market just because there's a lot going on. It'll be rather quick, but just it gives perspective of these 3 stocks and context of what's going on. So the buying started rather tepidly on Monday and Tuesday, and then it revved up in a big way on Wednesday after the Fed kept its core interest rate unchanged. And then the S&P 500 and the Nasdaq ripped higher as I'm recording this through midday afternoon trading on Thursday. So the Nasdaq was up another about 1.7%. The S&P 500 is up about 1.8% the last time I'm looking. So those surges have the S&P 500 and the Nasdaq both solidly above their 200-day moving averages, which they had both fallen below for the first time in a long time recently. So the bulls have shown they're not ready to give up the fight just yet. And actually, if we have another couple solid days, we could easily see both the S&P 500 and the Nasdaq touch those 50-day moving averages again. So Jay Powell on Wednesday kind of stuck to his normal playbook during his speech, stressing once again the Fed's going to remain diligent and it's hard to declare victory over inflation. But Wall Street put on its rose-colored glasses and pieced together the non-hawkish phrases from Powell and decided it was time to start sending stocks rallying again after that brutal October. We've seen Treasury yields slide from their recent peaks as well. So if the market's able to react positively to Apple and the job print comes in lower than expected or near what people are expecting on Friday morning, then yeah, as I said, we could see the market trend back up in the right direction after what was a really brutal October that had a lot of people nervous that we were going to be trending much, much lower. So obviously no one can predict the near term for the market, but it was great to see the bulls step in and take both the S&P 500 and the Nasdaq above that 200-day moving average. And if we can get back above the 50-day, it'll be very nice to see heading into the rest of the earnings season. So with that in mind, we're going to take a look at the 3 stocks I mentioned up top. And the first of those is Uber Technologies, which trades in the ticker UBER. So Uber, and they report their third quarter 2023 financial results before the opening bell on Tuesday, November 7th. So we're just going to jump right into Uber. So Uber stock has skyrocketed about 90% in 2023, and it currently lands a Zacks Rank #1 strong buy at the moment. So let's see if people are wise to kind of consider buying the ride-hailing firm right now. So Uber back in August reported a GAAP operating profit for the first time in its history, and Wall Street celebrated Uber's ability to expand its ride-hailing and delivery businesses, which are its core businesses, while also focusing on the bottom line, which is something they've been rewarding lots of tech stocks who hadn't been doing that for recently. So the Amazons of the world and the Metas of the world who are able to focus on the bottom line, once again, it's a good sign while focusing on their core business and expanding. So Uber, crushed our earnings results back in the second quarter. Its revenue was up 14%. Ride hailing was up big. Delivery was up solid. So all those core businesses showed that people are really back to living their pre-pandemic lives in full force. And once again, people who are using Uber are more inclined to be wealthier customers, and people who are Ubering all over the place are probably feeling the economic pinch a little bit less. That's obviously a generalization, but if we look ahead to our estimates, we can see that Uber is fighting through any of this worry about inflation and possible slowing consumer spending because their outlook looks really strong. So monthly active customer platform or monthly active platform customers climbed 12% last quarter. And looking ahead, we're calling for monthly active platform customers to climb over 11% overall in 2023 to 146.5 million, with trips expected to grow 21%, which is also projected to be up 33% from 2019. So that's that pre-COVID period. So really strong growth for Uber. And then if we look In terms of its projected revenue for the year, we're calling for 17% revenue growth in 2023 and then another 18% growth in 2024 to get up above 44 billion versus just about 32 billion in 2022. So some really steady top line growth for Uber. And then its mobility segment, which is that ride hailing segment, is supposed to see its revenue surge by 28% in 2023 with delivery up about 13%. So people are back to going all over the place in their Ubers. And then if we look at the bottom line, it's projected to swing from an adjusted loss of $4.65 per share last year up to 41 cents per share in positive earnings, and then soar all the way to $1.10 in 2024. And its upbeat earnings revisions help it grab a Zacks Rank #1, a strong buy at the moment, and it's crushed our earnings per share estimates in the trailing 3 quarters. It is worth noting that its most recent / most accurate, so the most recent analyst estimate we've had for Uber came in below current consensus for Q3, Q4, and 2023. So take that as just a sign that possibly that we could see it trend in the wrong direction. But overall, the consensus estimates are still really strong, but the most recent estimate is coming in below consensus. So if we expand our scope to just more broadly about Uber, it's focused on the here and now, as I said, profitability and its core businesses of delivery and ride sharing or ride hailing, while also preparing for the future. So the company did lots of business, or I should say deals during that COVID boom period. So they bought delivery peers Drizzly and Postmates, and they're rolling out more advertisements across the core Uber app. If you've used Uber or Uber Eats recently, I'm sure you've seen those ads, just a way to monetize their core ride-hailing delivery businesses. So that's great to see. And then along with that, they're trying to become more efficient, less errors on the delivery business. Streamlining everything is the name of the game in this higher interest rate environment where everyone's focused on margins and profit. And then all while doing this, they're focused on the long-term goal of possibly being in that autonomous world of vehicles, both delivery and driving people around cities. So they've made deals with Waymo for autonomous driving, and they could be down the line either competing with or next to a slew of big tech players, including Tesla, in a world that will kind of seem like science fiction. But in the here and now, they're still doing really well while also focusing on the future if we ever get to that place. And then in terms of price and valuation, Uber's up about 12% since its May 2019 IPO. That lags the tech sector's about 70% climb. That said, Uber shares have climbed roughly 60% during the last 12 months to top tech's 40% and crush its rival Lyft, which is down about 30% over that stretch. And then, as we mentioned up top, Uber's soared in 2023, up almost 90% year to date, and it still trades 30% below its average Zacks price target and below its, obviously, its all-time highs. Uber is trading at a back above its 50-day moving average as well, and it's recently surged out of oversold RSI levels. It's also trading at a 65% discount to its own highs when we look at forward sales. So it's trading about 2.1 times forward sales and 43% below the Zacks tech sector. And its PEG ratio, which factors in bottom line growth, sits at 1.0 versus tech's 1.8. So solid valuation there as well. So longer term investors might want to consider Uber as it proves it can focus on the bottom line, thrive in its core businesses while looking ahead to the future. And Wall Street's pretty high in the stock. 28 of the 34 brokerage recommendations that Zacks has are strong buys, with 4 buys and 2 more holds. That said, if you're attempting to buy Uber just for a post-earnings release surge, that's always a somewhat dangerous game to play. And now we're going to move on to AppLovin, which trades on the ticker APP. So App, they are going to report their third quarter results on Wednesday, November 8th. So AppLovin shares have soared about 260% year to date. This blows away NVIDIA and many other of those high-flying tech stocks. It also currently lands a Zacks Rank #1 strong buy. So let's dig into AppLovin. The company designs tools to help developers improve marketing, revenue generation, and other critical aspects of the broader app segment of the economy. to help drive profitable near-term and long-term expansion. That's their goal. The firm plays a key role in the wider app ecosystem with end-to-end software solutions that aim to optimize monetization through various products and solutions. The goal there is kind of help app developers acquire and keep their ideal users, increase value across the customer's lifecycle, measure marketing, all of these various things. Solutions aim just to boost the average revenue per user, scale ad impressions, acquire more valuable users, and so on and so on. Just trying to help all the people who are trying to get their apps in front of people and grow their business in that app economy. They've been gaining steam recently through some new advancements in their machine learning and AI focused offerings. Obviously, AI is the buzzword everyone's been focusing on Wall Street, but they say their new AI-focused engine dubbed Axon 2.0 is generating really impressive results and helping it post, quote, record software platform revenue, high margins, impressive operating leverage, and ultimately robust free cash flow. They see it helping nearly every aspect of their business, including the ability to get their clients more exposure in the connected TV landscape. So overall, they see their enhanced AI-focused features leading to even better return on investments for customers, which should lead to expansion for them and growing market share in their line of work. So the company has crushed our Q2 estimates back then over the summer by 175%. It boosted its guidance as it's improving its margins and attracting more business through that predictive AI-driven updates. So App's consensus Zacks earnings estimates have surged for both 2023 and 2024 to help it land a Zacks Rank #1 strong buy, just like Uber. And overall, Zacks estimates are calling for its adjusted earnings to soar about 340% this year, from 18 cents per share all the way up to 79 cents per share, and then climb another 74% next year to up to $1.37 per share. So big bottom line growth for AppLovin. And similar to Uber, its most recent / most accurate estimates for Q3 came in slightly below consensus, but it's still solid outlook, and it still has a Zacks Rank #1 strong buy. So it means its overall earnings estimates are trending heavily on the right direction. And then on the revenue front, it's projected to post about 10% sales growth this year, and then another 13% growth next year to climb from about $2.8 billion to about $3.5 billion in 2024. App shares have skyrocketed roughly 260%, as I mentioned up top, to blow away the likes of NVIDIA. This also includes a 130% run in the last 6 months, so recent positivity as well. And despite that, it's still trading roughly 65% below its November 2021 records. And it went public, we should note, in April of 2021, so kind of at not the best time, a nice run, and then it suffered that major tech sell-off. AppLovin's average Zacks price target also marks 14% upside to its current levels, and it's currently trying to retake its 50-day moving average after it climbed out of oversold RSI territory recently. Now, turning over to the valuation side of the coin, AppLovin currently trades at about 28.6 times forward 12-month earnings, which marks a 37% value compared to its own year-long median. And then if we look at its PEG ratio, which factors in longer-term earnings growth outlook, it's sitting at 1.4, which marks a really solid discount to the broader Zacks tech sector, which is at 1.8. So overall, its portfolio of products and solutions are really vital in a highly competitive world of that digital app economy, and where everyone's fighting for awareness and screen time and profitable success in a, frankly, just smartphone-obsessed world. So it's a good business to be in, both now and probably for the foreseeable future. And Wall Street really remains very high on the stock, with 12 of the 17 brokerage recommendations that Zacks has sitting at strong buys. Like I said, with Uber, same as the case with AppLovin. If you're trying to buy the stock just for the possibility of a big near-term post-release pop, that's always a risky play. But if you're looking to get into a longer-term investment of AppLovin, it's certainly worth considering at the moment. In the last stock we're looking at today is Pure Storage, which trades in the ticker PSTG. This is not reporting next week. It is currently projected based on the Zacks earnings calendar to release its results on November 29th, though the company has yet to confirm that date. So at some point in the next several weeks, Pure Storage should be reporting their quarterly results. So with this in mind, it is an enterprise storage hardware and services company that offers what it calls storage as a service model seamlessly across multiple platforms and clouds. It has expanded its offerings by helping its clients reduce complexity and put their data to use. So this is a world where everyone has so much data and companies can kind of ill afford to cut back on something as essential as data storage. And it's continued to boost its earnings outlook for several years, despite all the worries last year of a recession. And this year, more and more people are worried about slowing spending in multiple areas such as cloud. But their earnings revisions continue to trend heavily in the right direction as people are gravitating more and more towards their offerings. So if we look back to the start of 2020, their earnings revisions have pretty much trended straight up since then for all time periods, and even their 2023 and 2024 and now 2025 estimates are trending heavily in the right direction, and they've beat pretty much every quarter for the last 3.5 years, so a great sign there. And its positive bottom line revisions help it land a Zacks Rank #1 strong buy right now. Current Zacks consensus estimates call for its sales to climb about 8% this year and then another 16% next year. This is marking a substantial slowdown from what it's done in recent history. For the last 2 years, it did about 26% growth last year on the top line and 30% growth the year before that. So slowing growth, but it's growing on top of those difficult to compete against years, and it's supposed to still do 16% growth next year. So positive sign. And meanwhile, its adjusted earnings are expected to climb about 9% this year and then 18% next year. And the cloud storage firm has crushed our bottom line estimates. So that's great to see, including a 21% beat last quarter and then 100% beat the quarter before that. The company's industry currently sits in the top 30% of over 250 Zacks industries, and it also sports some positive style score grades, so that's a good sign. And then Wall Street's also really high on the stock with 14 of the 17 brokerage recommendations that we have coming in at strong buys. And Pure Storage's management sees room for continued growth as enterprises, as they say, continue to just struggle to manage their exploding volumes of data. I'm sure wherever you work, there's just endless amounts of data in our digital everything world. And they're offering what they say is just really simple automated solutions to store all of that. They said most recently on their last quarter that customers have responded really enthusiastically to its new ability to safely satisfy all of their data storage needs on a single consistent flash data storage and management platform. So that's a good sign amid all of these competing businesses who are all competing to help you store your data. So the stock's up about 68% in the last 5 years versus the broader tech sector's 90% climb. And it's gone on some really big swings during that stretch. So it's been a rather volatile stock. It is currently up about 12% in the last 12 months, including a 53% climb since early May. So one of those big runs recently for the stock. It's trading roughly between its 50-day and 200-day moving averages and around neutral RSI levels. And its current Zacks consensus price target offers about 27% upside to its roughly $34 per share it's trading at right now. And its valuation is still not the best. It's a little pricey for most people. Its PEG ratio is trading at 5.2 versus tech's 1.8, so not the best sign there. That said, in terms of forward sales, it's trading at 3.1 times forward 12-month sales, which actually marks a discount to tech, which is sitting at about 3.6. So Pure Storage doesn't report for at least several weeks, but certainly another name to consider as a longer-term play in the wider data storage universe. But as I said, with all of these stocks today, if you're looking just to buy it for an earnings pop, it's always a risky investment. But as I mentioned with all three of these stocks today, so Uber, AppLovin, and Pure Storage, if you're looking to make a longer term investment, they're certainly worth considering at the moment and digging a little deeper into. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.